Every day, large-scale enterprises process millions of billable items. In SAP Contract Accounts Receivable and Payable, or FICA, each of these raw transactions must be translated into a rigid, structured financial posting. This process culminates in the SAP Convergent Invoicing Document. It serves as the finalized ledger of what a customer owes based on their consumption or service usage. If we examine the bottom of this invoice, we see the summarized GL item section. The system has already calculated and assigned specific accounts for sales revenue and sales tax. The specific account assignments shown here are the output of a configuration engine that evaluates the metadata of every line item against the global chart of accounts. To understand that engine, we need to view this document as a standard accounting journal entry. We can isolate the transaction using a T account, with debits on the left and credits on the right. On the left, we have the debit to accounts receivable. This is the business partner subledger item, representing the specific balance tied to a customer's contract account. On the right are the corresponding credits to revenue and tax. These are the general ledger items that update the company's income statement and tax liability. How does the system automatically identify which general ledger accounts to use for both sides of this split? The answer lies in how the system routes data between the subledger and the general ledger, ensuring that customer-level detail always aligns with corporate financial integrity. FICA avoids static account mapping. Instead, it employs a dynamic transactional determination matrix to handle various types of billing items. This diagram shows the matrix logic bridging product types to general ledger accounts via posting areas. The first dimension is organizational, using company code, division, and chart of accounts. The second dimension uses main and sub-transactions to classify the service, like internet or telephony. Only by intersecting these organizational and product dimensions can the system automate financial postings at the scale required by global enterprises. Let's apply this logic to the debit side of our entry, the business partner item. This side of the posting is managed by Posting Area 2611. This table is responsible for determining the general ledger reconciliation account for receivables. While individual invoices hit the customer subledger, Posting Area 2611 summarizes that activity for the general ledger. In this table, a specific main transaction maps directly to a GL account. Sub-transactions are bypassed, since receivables are grouped at the main transaction level for reporting. This ensures that millions of individual customer transactions always reconcile with the primary corporate accounts. Now we shift to the credit side, the revenue and tax items that impact the profit and loss statement. Posting Area 2610 handles general ledger items. Revenue requires high granularity, relying on the sub-transaction column to route items under the same main transaction to different accounts. This tracks installations separately from subscriptions. Lastly, a tax determination column automates the invoice's tax posting. Posting Area 2610 serves as the primary engine for revenue recognition, providing the precision required for statutory financial reporting. In the SAP ecosystem, every profit and loss posting must also integrate with the controlling module for internal management reporting. This connection is established within Posting Area 2610. On the far right of the configuration table, we find the CO Act column. This field assigns account assignment keys to revenue lines, which tell the system which internal cost center or profitability segment should receive the credit. We can see this in the SAP Implementation Guide, where the definition of these CO keys is built directly into the automatic posting framework. This field connects the financial posting to a specific internal cost object, enabling profitability reporting to run alongside external statutory requirements. When a revenue item is processed, it passes through the 2610 matrix and updates the FI general ledger and the CO profitability segment simultaneously. This entire process is an automated symphony. 2611 manages the subledger reconciliation, 2610 maps the P&L, and CO keys update internal reporting. This underlying matrix is what allows a business to scale its billing volume while maintaining a perfectly balanced set of books. This precise routing between the subledger, general ledger, and management accounting provides the structural foundation for consistent corporate financial reporting.